The housing market, a cornerstone of the US economy, is showing signs of volatility. After a period of unprecedented growth, characterized by soaring prices and bidding wars, the market is experiencing a shift. Prices, while still historically high, are beginning to soften in many areas. Inventory, once scarce, is gradually increasing, albeit from record lows. Is this a natural market correction, a healthy breather after a period of exuberance? Or are we witnessing the early tremors of a looming housing bubble burst, reminiscent of the 2008 financial crisis? Understanding the dynamics at play is crucial for both potential homebuyers and current homeowners. Navigating this complex landscape requires a balanced perspective, one that acknowledges both the risks and opportunities that lie ahead. By delving into the factors shaping the current housing market, we can gain a clearer understanding of the potential scenarios that may unfold in 2024 and beyond. To assess the likelihood of a housing bubble burst, we must first understand the economic forces that typically precede such events. One key indicator is the relationship between housing prices and fundamental economic factors such as income levels and rental rates. When housing prices significantly outpace these fundamentals, it creates a disconnect, a potential bubble fueled by speculation and unsustainable expectations. Another crucial indicator is the availability and cost of credit. Easy access to mortgages, often with lax lending standards, can inflate demand, driving prices to unsustainable levels. Conversely, rising interest rates can dampen affordability, slowing down demand and potentially triggering a price correction. Interest rates, a key lever controlling the flow of money in the economy, wield significant influence over the housing market. The Federal Reserve's monetary policy decisions, particularly regarding the federal funds rate, have a ripple effect on mortgage rates, directly impacting affordability and demand for homes. When interest rates are low, borrowing becomes cheaper, making mortgages more accessible to a wider pool of potential buyers. Conversely, when the Federal Reserve raises interest rates to combat inflation, as we've seen recently, mortgage rates tend to rise in tandem. Higher mortgage rates translate into larger monthly payments, reducing affordability and potentially pricing out some buyers. This cooling effect on demand can lead to a slowdown in price growth or even a decline in certain markets. Understanding the direction of interest rates is therefore crucial when analyzing the potential trajectory of the housing market. The strength of the job market is inextricably linked to the health of the housing market. Employment rates, wage growth, and job security are key drivers of housing demand, influencing both the ability and willingness of individuals and families to purchase homes. When the economy is robust, unemployment is low, and wages are rising, more people feel confident about their financial future and are more likely to make significant financial commitments, such as buying a home. Conversely, economic downturns characterized by job losses, wage stagnation, or uncertainty can have the opposite effect. Therefore, closely monitoring employment trends and labor market indicators is crucial when assessing the potential future of the housing market. Looming over the current housing market is the specter of the shadow inventory. This refers to the backlog of homes that are not currently listed for sale but could potentially enter the market in the near future. The composition of this shadow inventory can include properties facing foreclosure, those withdrawn from the market due to unfavorable conditions, and homes held by investors waiting for the opportune moment to sell. Some analysts believe it to be substantial and poised to flood the market if prices begin to decline significantly, putting further downward pressure on values. Others argue that the shadow inventory is smaller than perceived and that its impact will be more gradual and localized. Understanding the dynamics of the shadow inventory is crucial for both buyers and sellers. In light of the current uncertainties surrounding the housing market, both potential buyers and sellers are understandably seeking guidance on how to navigate this complex landscape. For potential homebuyers, it's crucial to balance the desire to enter the market with a realistic assessment of affordability and risk tolerance. Sellers, on the other hand, face the challenge of setting realistic pricing expectations in a potentially shifting market. Consulting with experienced real estate agents, highlighting a property's unique features, and being willing to negotiate can increase the likelihood of a successful sale. Ultimately, the best approach for both buyers and sellers is to adopt a long-term perspective and seek guidance from trusted financial and real estate professionals. Predicting the future of the housing market is a notoriously challenging endeavor, fraught with uncertainties and potential for unforeseen events. However, by analyzing current trends, historical data, and expert opinions, we can develop a balanced outlook for the remainder of 2024 and beyond. Most experts agree that the era of rapid price appreciation witnessed in recent years is likely over. A confluence of factors, including rising interest rates, persistent inflation, and affordability concerns, is expected to moderate price growth in the coming months. Some regional markets, particularly those that experienced the most significant price surges, may even see modest price declines. However, a full-blown housing bubble burst, akin to the 2008 crisis, is not considered the most likely scenario. The current slowdown is viewed by many as a much-needed market correction, rather than a harbinger of a catastrophic collapse. While uncertainties remain, a balanced perspective, informed by data and expert analysis, can guide both buyers and sellers towards making sound decisions that align with their individual circumstances and long-term goals.